Hello, and welcome back to Let's Chat with Jen and Angie. I'm Angie, and together, Jen and I are Heart and Home Legacy Group with Edina Realty. This episode, we're going to talk about the big question. On September 17th, the Federal Reserve reduced rates. So I've had all kinds of people coming up to me and asking me, what are the rates? What does that look like? What does that mean? So let's talk about it. This week, the Federal Reserve cut its benchmark, which is the federal funds rate, by 25 basis points. That brings that target range down to 4.0 to 4.25. That is not interest rate. So let's talk about what that means. Now, first, I want to make sure to mention that the rate hadn't been cut since all year. So all of 2025, we haven't seen an interest rate cut, and they are talking about doing two more this year. So that means September, we have October, November, December. So we could see two more rate cuts. What does that mean, and what is that going to look like? Nationally, the experts are forecasting, let's say, quoting Fannie Mae, which is a federal national mortgage association. Fannie Mae is projecting for rates in the next 3 to 6 months, or they're calling that fall winter of 2025. They're expecting them to be about 6.5. Now, these are national numbers. Forbes, through the mortgage rate forecast of 2025, said that many forecasts expect the average 30-year fixed rate to remain in the mid sixes. Right now, we're talking mid sixes. Even if the rates were to drop, the feds were to drop the rates a little bit, they're still going to not go under that 6 mark, is what they're saying. Now, Yahoo Finance was asked, when will the mortgage rates go down? And they said that they're not expecting a large drop through much of 2026. Isn't that crazy? So they're seeing everything to stay at or above 6. So right now, the national average we had just got done saying was that 6.35 range. So 6.35 nationally, and now they're thinking it'll stay around 6. Now, that 0.35 does make a big difference in your payment, so keep an eye on that as well. All right, let's talk about Minnesota. So national is one thing. Now let's talk locally and talk about Minnesota and how Minnesota is affected by this. So as of today, in the state of Minnesota, for a 30-year fixed rate mortgage, it's going to be roughly 6.19. You say, well, that national average is 6.35. There's a lot of different factors that come into each state's rates. And local real estate and mortgage sources are saying that rates are projected to stay in the sixes for the rest of 2025 in the Twin Cities. So we're seeing that again. Everything's going to stay in the sixes. But what's nice about Minnesota is that our average rate is lower than the national average. And you say, well, why would that be? So let's talk about different scenarios of why that might be. So let's talk about competition among lenders. If local banks and credit unions continue to compete aggressively, they may offer better rates or more favorable terms, pushing rates downward in Minnesota faster than national averages. Isn't that interesting? So don't give up on your credit unions, your local banks. A lot of them have a lot of different programs that help you, depending on your situation, with your purchase and getting you the rate that's going to best fit your needs. Another thing is the credit profile of buyers in Minnesota tends to be fairly better. It's a good credit. We have got great buyers in the state of Minnesota, so good job, everybody. But because of that, that can provide stronger profiles that help see rates reduced. Let's talk about housing inventory and turnover, and what does that mean? So if there's more supply and more listings, that tends to help with flattening the rate spreads and improve the rate offerings overall. So if local inventory remains tight, then the competition is going to keep those prices high and the rates high. If we have lots of listings, we're going to keep that rate flattening and them spreading it out. So it's really good that we still continue to have listings coming on the market. So if you're looking to sell, look at yourself as you're also helping the market because you're going to get a good rate, going to take good care of you, but you're also going to help with keeping those interest rates down. Local economic strength is another part to it. So if Minnesota if we have local job growth, we keep inflation, which is local costs like housing, energy, insurance, and even property tax. If those changes, it can affect borrowers' risk assessments, which can then affect the lender's spread of those interest rates for that buyer. Now, policy and regulatory changes. If there was something like a state incentive, if there was mortgage-backed security programs or regulatory pressures to ease lending, that could also help push lower locally. Wow, lots of information. I hope that you are understanding that rates are going to be rates. They're going to be about 6%. There is going to be a difference in your payment from 6.19 to 6%, even 6.35. But what the professionals are all saying is that, yes, we're going to have 2 more interest rate drops. And yes, the mortgage rates could get affected. But realistically, they're going to be staying for a 30-year fixed mortgage about that 6 to 6.35 range. And we want you to make sure that you're reaching out to a bank, a loan officer, a credit union, a bank that's going to get you set up on the program that's going to make you the most successful and have you set for success. There's all kinds of them out there. And Minnesota is showing that we have a lot of different programs. So if you have questions, email us with our emails below. We would be happy to help get you to a professional. We hope that you found this to be helpful. Don't forget, stay grounded, stay grateful, and keep building that legacy. Bye.